Hello, hello, everybody. This is Lo Que Callamos, los loan officers. And we are here to teach you and also to answer so many questions that come from different buyers and the mortgage process. So let's get started. What's the biggest mistake buyers make when getting pre-approved? So today we have Alessandro Ibanez, our CEO, and Zoila Luz Fiorillo to answer those questions. Alice.
All right, well, let's get started with Zoilita.
The biggest mistakes people make when they get pre-approved is either, and this sounds so like a joke, but they go and buy a house. They open a new credit line. And because if you open a credit line while you're being pre-approved and it results of a debt, it's going to have an impact on your buying power. It's going to probably decrease. Another one that I see is getting their credit ran a lot of times. And then the underwriter verifying, any inquiries. And if you're close to expiring and they need a new credit report for whatever reason and your credit score drops, that has an impact on your program.
I would say that the biggest one that I've seen is the large deposits into the bank account or undisclosed debt. Basically, debts that should not or are not on your credit report and suddenly are on your bank statement. So I would say those are one of the biggest ones. I've also seen people where they stop working and they decide to change jobs. I will avoid those things because I understand you get another job and you wanna you will get paid more or something, but that could have an effect on your qualification. Another one actually is, for example, if you have a person that decides to go self-employed, you're a W-2, you're working with a salary, and then suddenly you decide to become self-employed. That is also a problem. So little things that could affect the qualification, but of course there is always a solution. And the most important thing is get educated. Inform yourself as to how you can have a smooth process, right?
Yeah.
You mentioned a lot about the credit report and taking care about that important score that we need to apply. How can we improve the credit score of a buyer, of a customer that is thinking of buying a house?
It depends on if it's bad, how bad is it, and what is it you can do. For instance, people that have late payments, I think there's nothing you can do to improve that other than paying your things on time and letting time go by. It's as if somebody just stabbed you in the back, which is what you did to the creditors by not paying as you promised that you would. And then, that's one. That's like the worst ones. But if you have okay credit and you want to improve it, I will say keeping your balance to 30% of what the limit is. That really helps you, as well as paying things on time, keeping your 30%, not having a lot of inquiries. I know a lot of stores go and offer you a discount if you try to apply for the credit cards. And a lot of people say, I want to get 20%, I'll try to apply. That's an inquiry, and it has an impact on your credit score.
What's an okay credit score? But you mentioned you have like an okay score.
Okay, it's like a 640, 650, it's okay.
Yeah. I highly recommend, for example, if you have, of course, bad or okay credit score, getting an authorized user added. So, for example, if you have a family member that has a good credit card and you get added to that credit card as an authorized user, that will improve your score in 30 days. So I highly recommend that if you want to improve your score. Now, of course, that doesn't count as a trade line, but it improves your score, which is what you want at the end of the day to be able to get a better interest rate.
I will advise that if you have any children that are, at the age of, I think you have to be 18. To add them as a credit, because it's better to have no credit than having bad credit. And if you add them as an authorized user on your credit card, which is how you started. I don't know if you want to tell your story, but real story.
No, but of course, getting added, in my case, my mom added me on her credit card and I didn't even know. But that's why I have at early times a perfect score, because I was added on her credit card. So I highly recommend getting authorized user. Another idea, and I highly recommend this for people that do not have any trade lines at all. So go take $300 and go to any bank, okay? Deposit those $300 and give them apply for a secure credit card. So you give the $300, give it to the bank, they give it a secure credit card. Use that credit card by spending and paying. For example, if I spend $300, pay $300. If you spend $150, you pay $150. If you spend $200, you pay $200. If you do that every time, your score is going to improve. And you can do that with the secure credit cards. What's going to happen is after a year that you have been paying on that, you will actually get that money back, and your credit limit will increase to $1,000, for example, and then you can start using the same credit card that way. But that's probably one of the best scenarios in terms of improving your credit score.
Talking about inquirers, sometimes people can be concerned about losing points when like a mortgage company wants to pull the credit score, which I would like to clarify because it's different than from a credit card company, right? Or a different store. So can you please explain what's the difference?
Yeah. So there is definitely a concern, right? That when somebody pulls your credit, your scores are going to drop. Here's the truth. The truth is that when you apply for credit cards or installment loans like auto, furniture, those will have a direct effect on your credit, and yes, it will drop. But if you're applying for a mortgage with a mortgage company, not a credit card company that happens to be a mortgage company, with a mortgage company, actually your score will stay the same. Why? Because you're allowed to shop around and just go out and check it out. Pull credit with one, if you and then you pull it with another company, the score will be the same. It will not change for the next 30 days because you are allowed to shop around. So that's what happens when you pull a credit report with the mortgage company, okay? But of course, if you're doing credit cards, installment, those will pull you many times, and those will usually lower your credit score for the next time.
That's an important question. What's the difference between being pre-approved and pre-qualified? Because those are two different steps, right? And people may get confused about that.
A pre-qualified to me is when the client basically only gives you pay stubs and then wants to know how much they qualify based on that. Or they tell you how much they make and what they have, that you don't verify any. Well, you don't verify all the four factors that I always talk about to evaluate and assess somebody's buying power and risk of paying back, then that's a pre-qualification. But the moment that you submit all your documentation that is requested, that's a pre-approval, which ensures a smoother underwriting process.
Yeah. And I also recommend, providing all the documentation and allowing the company to do a verification, for example, verification of employment. Sometimes we also ask verification of transcripts. It's not that we don't trust that those taxes are accurate, but it's just that we have seen so many times, time and time again, where we ask for transcripts and we don't find it with the IRS. Why? Because the accountant did not file it, or because there was an error or mistake when you guys were filing it. So I highly recommend doing the transcripts, have an account with the IRS to get the transcripts, getting a verification of employment up front. I think that's one of the best scenarios. Showing your bank statements, I think that's key. 80% of the transactions that usually have trouble are going to be because of bank statements. That's the truth. And then, definitely having understanding how the process works, where there is different parts moving at the same time. Appraisal, insurance, title commitment, in the loan, of course, the conditions. There's so many parts involved when you're applying for a mortgage. So be patient, pay attention to the details. And if the loan officer is asking you questions, provide as much information as possible so that we don't make a mistake, or nobody makes a mistake. And then you can have a great closing.
I was going to add that. I feel like it's better to have more information, more documentation than less.
Yes.
Because we can structure. The mortgage loan officer's job is to structure a loan in a way that it works out. And if that means not showing, a bank statement where showing a big deposit, a big cash deposit, then we will avoid that. And it will guidance the client and whatnot.
Loan officers they have to do that. We have to fight battles that you didn't even know existed, right? So there has to be an understanding that the reason why we're asking questions is because we're trying to find a potential error on the documentation so that nothing goes bad on the loan. But you're right. So to that point, you're right. We have to ask so many questions sometimes.
Let's talk about type of loans and how do a different type of loan affect, let's say, FHA, VA loan, or conventional. It may impact the buyer's offer in a competitive market.
For some reason, and I know Alessandro disagrees with me, but for some reason, listing agents don't like FHA loans. And I know some of those reasons, because usually those type of loans are stricter when it comes to appraisal and
or FHA.
FHA are stricter when it comes to appraisal and whatnot. So they don't like it, and they feel, because some listing agents have some sort of idea that FHA loans are for people that have really low credit scores. Mm-hmm. So they think that there's an issue, it might fall through, and it may not work out. And I think because of their experience, they don't like FHA loans. However, I love FHA loans. It allows borrowers, even if you have an excellent credit score, to increase their buying power because their debt to income ratio is higher than a conventional one. FHA is backed up by the government. Conventional, it's not. So it's just two different things, and I always try to provide my clients the two different options, but the impact on the offer is basically that they don't like FHA loans. They like conventional loans, especially if they see that they're putting a lot of money.
I disagree, of course, with the part that you have to choose a contract based on the type of loan. I mean, listing agents, I respect your job, but everybody deserves an opportunity, and of course you're working for your seller to be able to get an easy transaction for them as well. So I completely respect that. But of course, I mean, most of us have bought with FHA loan. I personally bought with FHA loan as well, and everything went great. Then I refinanced into conventional. Does that make me less worthy of that house? No. I mean, I think everybody deserves an opportunity. VA, for example, this is an interesting discussion with realtors sometimes where they do not like VA contracts simply because VA is more protective of their customers, right? So I kind of love VA loan because you don't pay mortgage insurance, you put zero down payment, it's a very low rate as well, so it's a winner all the time. So I wouldn't be scared of a VA transaction, not for the appraisal, and if that means that I have to maybe as a seller put my house in a better shape, maybe we'll do that. That will allow me to get a higher offer, right? That's what I will do. But if I don't want to mess with any repairs or things like that, then of course at that point I probably will have to pick maybe a conventional transaction because exactly what you said is less restrictive. That does not mean that the appraiser may not call on something on a conventional appraisal, because remember, it's not the type of loan, it's the appraiser itself who provides an opinion of the property. And if the appraiser says this property needs repairs on the window or you have to put a handrail here, you have to do it. It's not the type of loan, it's the appraiser that provides an opinion about the transaction. And I highly agree that it doesn't make any difference on the type of loan. It always has to do with whether it's safe or whether it's a problem potentially for the person that occupies the property.
I have a question about that. What is the biggest difference you will say between an appraisal and an inspection? What are the different items that they look for?
That's a great question though, because an appraiser will only look at the value of the property, the comparables, and major issues that he finds on the property. He's not an inspector. Home inspector is not. An appraiser, their job is just to provide value, the comparables, and the major issues that may have the property to see if it will pass, in their opinion, the inspection. But a home inspector will look at every little thing, the roof. They will look at the plumbing. They will look at little items on the house, different items, to make sure that the property is in really good shape. It actually helps you as a buyer. I want to know what I have to fix in the future, right? Inspectors are not perfect. Home inspectors are not perfect either, but it provides an idea as to what should be fixed in the house so that when you occupy it or when you rent it, there is no problem with it. Like, for example, they check on AC, heating units, the electricity panel as well. They look at different things, and I highly recommend getting a home inspector simply because it allows you to understand what you should be aware of once you move in.
And the real condition of the house,
Yes.
definitely.
Another question. I'm sorry, Chris. Just a question about the appraisal. Again, there's different grades. I think you call it a grade 1, 2, 3, 4. Can you explain what that means and how that affects the
so
loan?
there is different conditions, the C1 through C6. Most lenders do not do C5 and C6 because C5 and C6 usually have bigger problems, right? The structural problems, the house is in really bad shape. Most lenders will work on C1 through C4. So condition 1, condition 2, condition 3, condition 4. C4 being a house that maybe needs repairs, but not that it is still be able to be occupied. A C3 is a house that maybe is in use, of course, but it needs some type of home improvement, nothing. A C2 is a house that has been remodeled, but to the normal average way. And a C1 is a perfect house, pretty much. It's like super remodeled, super nice. It's awesome. So you don't see that many C1s, but I see more C2s and C3s. Most houses are in the middle. probably a new build will be in a C1 level, in my opinion. But yes, we can do, most lenders will do from C1 through C4 condition of the house.
Important information. Let's talk about self-employees at the moment that they want to qualify for a mortgage loan, and what happened in the moment that their tax returns like don't show like a high income, but they don't have enough income to qualify.
So first is getting educated as to how much you should be filing. A lot of people have, they file on the tax of $15,000, $20,000 a year. And of course, that will not get you to anything. But that's not the truth. The truth that they're making more than $100,000 a year, right? So I highly recommend getting educated as to how much you should be filing and what forms should be used to be filed.
And all these strategies, Alice, they can apply also for that.
Of course. So we have the Schedule Cs, the 1120S, the 1120. Use depreciation as your best friend. Most accountants are not using it. They prefer to use miles, which, by the way, you can also add back miles, but it's not that much. Depreciation is probably the biggest and most effective expense on the taxes that will reduce your tax amount, but we will add that back into the income. So if you have machinery that you want to use as depreciation, you can do that. I mean, talk to your accountant to do that. But that happens on the Schedule Cs, 1120, 1120Ss, 1065 as well. That's for self-employed. So I highly recommend getting educated as to what or how much to file. For example, if you want to qualify for $500,000, you should be filing $100,000 net income, right? So I highly recommend that. But if you're trying to save on taxes, because you have to pay a big amount of taxes if you file $100,000 a year. So if you want to save on that, maybe look into the bank statement program. Now, bank statement programs, of course, will vary because you have sometimes a deposit of $5,000, another one of $10,000, and it changes through the months that you go by. But the good thing is that we can average that, and by averaging, you can use a higher income. And guess what? On those programs, you do not have to show tax returns. Therefore, you don't have to pay taxes. Yes.
Yeah. No. I was listening.
We are learning here.
Yeah. I will say another one will be profit and loss statement. Yes. I don't know if you want to talk a little bit about that.
Yeah. Profit and loss, I think it's a great program. It happens a lot with people that have sometimes cash deposit. We have some customers that they have the cash deposits. And of course, on bank statement program, we cannot use those cash deposits. But an accountant will. An accountant will use those deposits to with an invoice, of course, to validate it. And of course, once it is validated, they're going to include that on the financial statement, profit and loss. And then we're going to use the profit and loss, the net amount, to qualify the person. Another great idea to avoid having to show the tax returns, right? We don't pay taxes on that. Great. We only show the profit and loss. But of course, keep in mind that as you provide less documentation, you have to have a higher interest rate. You have to have a higher down payment. But of course, I'd rather that money go into the down payment versus the taxes. That's my opinion.
Yeah. That's great. So if you want more information, Alice, where can they call us?
You can call us 1-800-485-0102. 1-800-485-0102.
I love this part. And our social media?
You can find us on Instagram as Lo Que Callamos, Los Loan Officers, or USA Loans. And we're also on Spotify. This podcast actually comes out on Spotify and YouTube.
That's amazing. That's all for today's episode, guys. Remember, we are
Lo Que Callamos, Los Loan Officers.
Please stay tuned. We are coming with more information, more questions to answer, and we want to teach you more about the mortgage process. Bye-bye.
Bye.
Bye.